people make the exact same financial decision. At least, that's what it looks like. Same money, same income, same starting point. One buys a rental property. The other invests in the stock market. At the beginning, it's not even a competition. One of them looks smart, confident, in control. The other looks like he's doing nothing. No asset you can see. No monthly cash flow. No story to tell. If you asked anyone who's winning, they'd all pick the same person. And they'd all be wrong. Because what looks like a smart decision at the start doesn't always stay smart over time. Fast forward 10 years. They're almost tied. Fast forward 20 years. They're still close. But here's what nobody sees. One of them had to fight for every dollar. The other? Let the system do it for him. And once you see the full breakdown, you'll realize something uncomfortable. Most people don't lose money because they chose the wrong investment. They lose because they never counted the full cost. Welcome to the financial maze. Let's make this real. Jake and Marcus aren't special. They're not experts. They're not rich. They're just normal. Both are in their early 30s. Both earn about the same income. Both have managed to save $50,000. And now they face the same question. What do I do with it? This is where most people think the story is about money. It's not. It's about the decision. Jake chooses something tangible. He wants something he can see. So he uses the money as a down payment and buys a rental property. A physical asset. A tenant. A plan that makes sense in his head. Marcus goes the opposite direction. No property. No leverage. No tenants. He puts the money into the stock market, sets up a small monthly contribution, and walks away. That's it. No excitement, no story, no visible progress. The first few years make everything look obvious. Jake feels like he made the right move. Money is coming in every month. There's a tenant paying rent. There's a house he can drive by and look at. He can see his investment. He can touch it. And that changes everything. People ask him about it. They're interested. They're impressed. Jake looks like he's building something. Marcus looks like he's doing nothing. But here's the problem. Feeling like you're winning is not the same as actually winning. At first, everything looks clean, simple, predictable, but real life doesn't stay on paper. Things start to happen. Small things at first. A repair, a delay, a tenant question. Nothing dramatic, just friction. Then it builds. Something breaks. A month goes empty. A cost shows up that wasn't in the original plan. Suddenly, the numbers aren't as clean anymore. That extra money starts shrinking. Because what people see is the rent. What they don't see is the maintenance, the vacancy, the unexpected repairs, and the time. Time is the one cost nobody includes at the beginning. Jake starts realizing something. This isn't just an investment. It's a responsibility. Something he has to manage. Something that depends on him. Meanwhile, Marcus still looks like he's doing nothing. But something is quietly happening in the background. For a while, nothing seems to change. Jake is still managing the property, still solving problems, still thinking about it almost every week. Marcus is still doing nothing. And that's exactly why this moment is so dangerous. Because it doesn't feel like anything is happening. But under the surface, something has already started. Slow at first. Almost invisible. Then a little faster. Then a little more. Marcus's money is starting to compound. Not just grow. Multiply. The gains begin. Creating more gains. And those gains start creating even more. And now something changes. The growth is no longer coming from what he adds, but from what's already there. Jake is still building, but linearly. Marcus starts bending upward. And here's the part nobody talks about. This is where most people quit. Because the first few years feel slow, boring, unrewarding, and people mistake that feeling for failure. But the reality is the opposite. The slow phase is where everything is being built. And by the time it becomes obvious, the advantage is already locked in. Fast forward about 10 years. This is where most people expect the gap to be huge. They assume Jake is way ahead. More assets, more control, more real wealth. And Marcus is still behind. But that's not what happens. They're almost equal. Same starting point, completely different paths. And after a decade, they end up in the same range. One spent years managing everything, handling problems, making decisions constantly. The other did almost nothing, and they're in the same place. This is where the story stops being comfortable. Because now the question changes. It's no longer which one made more. It becomes what did it cost to get there. Most people focus on the number. But that's the wrong question. Because money is only part of the equation. The real question is, what did it take? Jake didn't just invest money. He invested time, attention, energy, late-night calls, unexpected problems, decisions he couldn't ignore. His investment needed him. Marcus's investment didn't. No calls, no emergencies, no constant attention. Just time. And that difference matters more than it looks, because time is limited. Every hour spent managing something is an hour not spent somewhere else, and most people don't calculate that. They look at returns, but ignore the cost behind them. Jake built an asset. Marcus built a system. One depends on you, the other runs without you. And, over time, that difference compounds just like money does. At this point, it's easy to pick a side. Some people will say real estate wins. Others will say stocks are better. But both are missing the point. This isn't about right or wrong. It's about trade-offs. Jake used leverage, controlled a larger asset, built equity with borrowed money. That's powerful. But it came with a cost. Time, responsibility, risk concentrated in one place, and stress that doesn't show up in spreadsheets. Marcus had no leverage, no physical asset, no monthly cash flow, but he had something else: simplicity, liquidity, freedom, and he had to deal with something most people can't handle: volatility, watching numbers go up and down without control, and still not touching it. Both paths work, but they work differently. One requires effort to maintain. The other requires discipline to leave alone. And this is where most people fail. They don't choose based on reality. They choose based on what they can tolerate. Here's what most people get wrong. They think the outcome is decided by the investment: real estate, stocks, business. They argue about which one is better. But that's not what actually decides the result. The real difference is how you execute. Most people never run the full numbers. They look at the headline: cash flow, returns, passive income, and stop there. But the real numbers are deeper. Time, stress, maintenance, behavior, consistency. Everything that doesn't show up in the pitch shows up in the result. And that's the trap. People choose based on the story, not the system. They pick what sounds smart, not what works for their life. And years later, they're surprised by the outcome. Because they never counted everything. Even when people choose a good strategy, they still lose. Not because the strategy failed, but because they did. The real trap isn't picking the wrong investment. It's not sticking with it long enough for it to work. The hardest part of investing is doing nothing. Watching your portfolio drop and not reacting. Seeing others move faster and not changing direction. Feeling like nothing is happening and still continuing. Most people can't handle that, so they panic, switch, chase something new, and break the system right before it works. That's how good investments fail. Not because they were bad, because they were interrupted. At the end of the day, this was never about Jake or Marcus. It's about you. Because at some point, you're going to make the same decision. Maybe not with $50,000, but with your time, your money, your attention. And when that moment comes, you won't choose based on math. You'll choose based on how it feels. What looks better? What sounds smarter? What gives you a story to tell? And that's exactly where most people go wrong. Because the best decision usually doesn't look impressive. It looks boring, slow, invisible. But over time, it becomes unstoppable. So the real shift is this: stop asking which one is better. Start asking what you can actually stick with for 10 or 20 years. Because that answer is the only one that matters. Most people will watch something like this and still do the same thing. Not because they didn't understand, but because it didn't feel urgent. That's how these decisions always work. They don't look like turning points. They look like normal choices. And that's why they're so dangerous. Because small decisions, repeated over time, don't stay small. They become outcomes. One day you wake up years later and realize you didn't just choose an investment. You chose a path. And by then, the result is already locked in. So the question isn't which one makes more money. It's what kind of life you're building with it. Because in the end, that's the only return that actually matters. Welcome to the financial maze.